Good morning, good afternoon. Thank you very much for joining us for the latest Kepler webinar tracking the US-Iran conflict. Today, we will be covering the latest developments in shipping, freight, and risk. And I'm very pleased to be joined today by my colleagues, Head of Dry Research, Alexis Ellender, Senior Risk Analyst, Anna Subasic, and very, very pleased indeed to have Ellis Morley, Divisional Director of Cargo and Commodities from Howden, who will be able to give us an inside view on what's been happening from the maritime side of insurance over the last few days. My name is Matt Wright. I'm the lead tankers analyst here at Kepler, and I'll be sort of taking us through the next hour on what's been happening in the market. So we're going to be going through the tankers, LNG, LPG, dry segments, insurance, and of course risk. And we'll hopefully leave enough time for Q&A at the end. So please do use the Q&A box, get your questions in, and we'll cover those when we come to the end. But let's get started with a status update. So the situation in the region remains incredibly unstable. Two more ships were attacked last night. And while there is still a huge amount of uncertainty, there are a couple of factors that are becoming more clear. So starting here, we can see transits are obviously down significantly, and that is likely to remain the case. We've got between 88 and 100% decline in transits depending on the vessel type. We are still seeing some tankers moving in and out, mostly under the cover of an AIS blackout. But fundamentally, there's very, very few vessels moving in and out of the Strait of Hormuz. And this is just the pure, as we've seen over the last few weeks, the risk in the area is very, very high. If we move to the next slide. So what's been happening within the Mideast Gulf? So there's still a significant number of vessels in the Mideast Gulf, obviously with vessels unable to exit or unwilling to take the risk. The majority of these vessels are actually now laden. A lot of them continue to load and are now sort of waiting. The bulk of these, as you would expect, are crude tankers, and you can see we've got a huge increase in commodities on water across all vessels in the region. In terms of vessels that are trapped in the Mideast Gulf, you can see across dry bulk, LNG, LPG, and liquids, pretty significant, particularly on the liquid side, a pretty significant share of the fleet there, 6% of total tanker fleet trapped. But significantly, when you actually dive into this on a vessel by vessel basis, for the VLCCs, that is the sector that we see fundamentally most exposed here, with 10% of compliant VLCCs in the Mideast Gulf. Now, while that is a significant number, the Mideast Gulf accounts for over 50% of VLCC exports. While this is a high number in terms of the fleet, the loss of exports from the region is actually far, far more significant there. So while this is the current situation, I think the first thing that we wanted to do is bring in Ellis now to give us a bit of an understanding on what's been happening. Insurance has obviously featured very heavily in the media since the weekend. But Ellis, if you could, give us a bit of an update, what has been happening, and sort of give us, go back to basics, like what are war risk clauses and how do they work in practice? I think we might have lost Ellis. There he comes.
Hello, can you hear me?
We can.
Sorry about that. I'm not quite sure what happened there. Bit of technical issues always. Yeah, so sorry. So thanks for the introduction and thanks for having me on. Yes, I'm Ellis Morley. I work at Howden. I'm within our marine cargo and logistics practice. I focus on commodity business and also lead our cargo war placements. We've been running a sort of a war desk since the start of the Russia-Ukraine conflict, and then we were assisting clients, ship owners and traders throughout the Red Sea conflict, which still on to date. And then obviously now this week has been pretty busy with everything that's going on in the Persian Gulf and beyond. So I have got this map in front of me. I'm not going to talk about this just yet. I'm just going to firstly address there's quite a lot of noise in the press around the insurance market of how it is perceived to have not be assisting in this current conflict. Ultimately, the market has always been And Lloyd's, especially in London, has been a insurer of maritime risks, including war, for hundreds of years and continues to do so. Obviously, we're a risk-based market, so when the risk increases, then the price increases. Alongside really any other market, when one factor changes, another factor changes. For our side, our factor is we are taking on the financial risk of reinstating the ship owner value or the commodity value in the event of a physical loss or damage to in my case, a commodity trader or a ship owner. Um, so just on that point, this is the map I've got in front of us here is the JWC, which is the Joint War Committee. It's the Lloyd's of London committee that meets fairly every couple of weeks, but this week met on Monday morning to discuss the evolving risk landscape within the world of war insurance related to maritime threats. So that this map here is historically all of the areas that are considered high risk areas and therefore require an additional premium to transit. As you can see, we've got West Africa, you've got the Red Sea area, you've got the Persian Gulf, we've got Lebanon, Libya, we've got the Black Sea, we've got Venezuela, we've got the Pakistani coastline. These are a lot of these areas have been high risk for a long time, and the only change really this week is the severity of the risk. What's come out of the Joint War Committee this week are the two high risk areas. I want to say high risk areas. They're the ones who are red and white striped, like a barber shop. The one in the Red Sea that you can see from the Yemen, Eritrea down the Somali coastline, and then also the Persian Gulf area. That's now been merged together because what we've seen in the 9 strikes against vessels that have occurred since Saturday morning, which is a pretty crazy and scary number, is the range of
Mm,
where these are being struck. It's not just within the Persian Gulf, not just within the Strait of Hormuz, but even out as far into the Indian Ocean or the Arabian Sea, off the Omani coast. The area that on this map currently is outside of what's the perceived high risk area. So there's been a bit of a redrawing of the risk map. And then there's been a lot of the word cancellation, uninsurable thrown around, and the practice in which risk rating is adjusted because we're not an industry that trades as quickly as in terms of pricing as the commodities in the shipping world. We generally fix contracts for a 12-month period, and so that's not compatible with a war risk.
mm.
So then within contracts, there is a baked-in notice of cancellation clause in the event a war breaks out and war risk escalates. What's happened this week is underwriters have exercised their right to issue notice of cancellation. So there is a 7 day window in a lot of cases, from Monday this week. Then there is 7 days of coverage still available to clients at the existing rate they had. So whatever price was being paid before, and I'd say before the conflict in the ship owner market, there was already an additional premium being paid and had been for a while because of the perceived high risk in the Persian Gulf. I would say in the oil market, there was almost negligible. Well, it was a negligible, almost no risk premium for the war side actually being charged to the traders prior to the weekend. The view had been that there wasn't really many incidents of war strikes against oil-related industry. The Gulf all relies on that industry, and generally speaking, they've sort of left each other alone. So the ramp up had been quite steep on the cargo side, and I'm as I mentioned to you, Matt, I'm not going to go into specific pricing, but I can say obviously the price has increased quite a lot. It's still well within the regions of we're not increasing as much as say the freight rates are, or as much as some of the futures markets what we saw increase on Monday, and also the rates haven't gone up as drastically as some that we saw at the outset of the Russia-Ukraine war.
Yeah, and I think that's a significant point. I think a lot of the reports in the media is that vessels are uninsurable or the insurance is unaffordable. That's just not the case.
Yeah, I mean. some people would say it's unaffordable. A lot of the time, we negotiate with all sorts of people. Just so on my point of insurers have issued their notice of cancellation, so then there are 7 days now which are covered at whatever it was before. Some clients pay nothing for that risk currently, because it's part of a package. So then there are now 7 days, and then at the end of those 7 days, then they will have to have a new deal negotiated. As a broker, it's our job to essentially provide clients with the option of what the price is going to be when those 7 days expire. And I'm pleased to say that we were able to quote for all of our clients that have had notice of cancellation issued. At the same time, we're able to provide them with a price for that risk in 7 days' time. So there
And
is no element of uninsurability. There is a price increase, but there are also thousands of drones and hundreds of missiles flying around the Gulf. And
yeah,
our clients cover very large shipments of highly flammable commodities.
yeah. And I think that's important that the vessels are still covered, and many vessels are still covered by their existing insurance cover. So
Absolutely.
the fact that we're seeing vessels, say, within the Mideast Gulf who would like to leave but are choosing not to, would you say that that's maybe not so much about they're not being insured as so much as just the threat, the fact that there is a very real threat to their vessel?
I think that's absolutely it. Obviously, as charterers and as owners, you're being prudent, and it's the right decision. While there's a 34-mile width strait, and unlike the Red Sea where we were dealing with the Houthis, which are a rebel organization, the weaponry is different. Iran is a well-equipped, sophisticated, large sovereign nation in the Middle East. Like people, I don't know if I'm still underestimating them, but maybe did underestimate them. 34-mile wide strait is not it is very difficult to transit without being spotted, especially if you're on a VLCC, of which I think I saw on your data, something like 9.6% of the fleet are stuck in the Persian Gulf.
Mm.
It's not so much about insurability, it's about there is a very real threat. There have been 9 ships hit in 4 days.
Yeah.
It's a very real threat. There is insurance in place. Of the ones that I have heard, I believe there is one shadow vessel on there, which I think was the Skylight. I've spoken to underwriters in the market, and I know of, I think as of yesterday, there were 7 hit, and I'd already found out who was insuring 5 of them. So we don't believe this is an uninsurable risk by any means.
Yeah. Yeah, so the market is working, vessels are covered, it is just more expensive. Last night we heard, well, Trump told us directly that they would potentially offer naval escorts and separately that they would try to provide cover for vessels passing through the Strait of Hormuz. I mean, with the naval escorts, we actually have some understanding of how that would work from the Red Sea. Let's start with that first.
Yes, so that's a really interesting point, and I had that conversation last night with a couple of underwriters who we use regularly for war coverage. So at Howden, we've got a dedicated war facility where we can fill gaps for clients that are otherwise left in a difficult position. So I was speaking to a couple of underwriters last night about this. Naval escorts, absolutely right. Euronever Speedies did a brilliant job at times with escorting through vessels through the Red Sea. That we don't feel is going to be quite as helpful in the strait. As I've mentioned, it's a much smaller area in terms of width. It's also the Bab el Mandeb Strait. You're just going through a pinch point, and the Strait of Hormuz is a proper horseshoe round. So there is a lot of time within the vicinity of the Iranian armaments. I mean, and
Mm.
let's get mistaken. You're within the range of the Iranian armaments much further afield. We're seeing strikes as far as Cyprus, which is frankly quite scary. But for the actual strait itself, the naval escort, it's going to be very, very difficult for the US or any navy to escort vessels through the strait, just from a sense of actual feasibility of being able to countermeasure against the drones and ballistic missiles fired. But then also, even if you say that they are able to, what's the cost of if we're saying insurance cost makes it I wouldn't want to say uninsurable now. If we say that the straits are closed because of costs, what are the costs going to be to a navy trying to shoot down drone? We've seen how much the anti-air missiles cost for developed economies.
Mm.
It's not a cheap route of doing it, and I'm not convinced that it is necessarily one that is effective either.
Yeah, and I think with Euro Speedies, there was a series of vessels that would come in transit. We've heard that potentially the a naval escort here would be on a one by one basis, which would make it incredibly inefficient. As we've already seen, there's hundreds of vessels in the Mid
Well,
East
I know,
Gulf.
and you're right. I think the reason that they've said what a one-on-one is because of that level of that risk factor. We're talking when we were looking at the Red Sea and the Houthis, people were under the sort of false impression that the Houthis were firing from the shoreline. They were firing from quite far inland. You had quite a lot of lead time for this,
Mm,
and also the weaponry was not as advanced. I know they're obviously Iranian aligned, and some of the weaponry is Iranian, but Iran have got some seriously sophisticated weaponry,
yeah,
and it's a
yeah,
much shorter, much narrower strait with, as I say, that horseshoe shape that keeps you in the highest risk area for far longer.
yeah,
And then yeah, exactly as you say. Where's the commerciality of that? What's the freight rate going to say if we say, right, well, how many naval vessels are allowed in there? Maybe two or three. So then what? There's going to be two or three ships transiting a day. I think we're probably already still seeing that many, if
yeah,
not slightly more.
yeah,
And also, is it then going to be an element of who whose interests are going to be protected? Is it going to be for everyone? Is it a first come first served, like say like a Suez Canal style of you just waiting the queue, or are certain interests going to be put above others?
yeah.
We're quite skeptical. Let's put
Yeah,
it.
absolutely. Yeah, we do need to move on, but quick last one is obviously is a 2 point on the ability for the US government to provide cover. Any thoughts on that?
It's no, it's too early really to come out with a properly educated view on it. It was last night that I think again I would go back to, are everyone's interests going to be covered by that? I wouldn't want to comment too much on it at this point. We're
Yeah.
we're looking into it.
Yeah, brilliant. Thank you very much, Ellis. I'm sure we'll have more questions in the Q&A, so
Thanks, mate.
don't go anywhere. If we can move on to the next slide, we're now going to turn through the different segments. So we're going to start with tankers, liquid tankers and LPG. So just a reminder, this is a snapshot of what the situation looked like last night. You can see significant number of vessels. The vessels obviously up close to Iran, they're Iranian vessels, but then off east coast of UAE, you've huge number of vessels. And just as a reminder, all of those vessels are within reach of Iranian drones. So there is a large number of vessels that are a threat, even if they're not passing through the Strait of Hormuz. Transits for tankers are down 88%. So this is the least compared with the other bulk vessels. We've got nearly 250 vessels in the Mideast Gulf, which is about 6% of the fleet. And as I said before, 10% of VLCCs. Exports from the Gulf account for 32% of crude seaborne flows, and even higher for naphtha, middle distillates, and LPG. LPG is a crucial one, and I do recommend. We have another webinar tomorrow on crude, refined products, and gas, where our analysts will be going through in even more detail on those markets specifically. As today we're really just focusing on the shipping and the freight impact. So yeah, let's move on to what's been seeing. So here, very, very stark, the increase in assessed rates. So this is on the left as Mideast Gulf China VLCC, the benchmark for the VLCC route out of the Mideast Gulf. And as you can see, we're at record highs. But I think what's important to emphasize is this is very much a theoretical freight rate. Very little is actually being fixed. As I've said, very few vessels are moving in and out. So this is very much a sentiment driven. However, there are vessels being fixed elsewhere. We've seen fixtures out of the Red Sea. And while the Mideast Gulf is more theoretical, the increase in freight rates from other regions, particularly out of the US Gulf, Brazil, West Africa, are not theoretical. Those there we have seen a big increase in VLCC rates from the Atlantic, and that is in response to this. Because if we're not seeing flows out the Mideast Gulf, China and other key importers around the world are going to be looking for supply elsewhere, and the US is one. US Gulf to China, obviously a much longer voyage, is also up around $13, $14 a barrel now as well. Very, very high. And you can see from the forward curves on the right where we're comparing the Mideast Gulf to China with US to China, both have jumped sharply. And the market is pricing in disruption at the moment of about 1 to 3 months. I think it's impossible now for anybody to be able to say how long this is going to go on for. I think you can take into account comments by Trump on how long he expects this to go on for, and expectations for how long Iran is capable to maintain the level of attacks. But at the moment, just taking in either the crude forward curve or the FFAs here, you can see that it does start to tail off over the next couple of months at the moment. Now, what I think is significant here is you can see the US Gulf to China moves to a premium over the next couple of months over Mideast Gulf China, and that is the expectation that we will see sustained demand from the Atlantic basin as in terms of sourcing crude for supply in China, and I think that's significant. That the market is expecting freight rates outside of the Mideast Gulf to maintain a high premium, depending on how long the situation is. If the situation in the Mideast Gulf remains difficult in terms of transits, and we see restrained flows for a long time, then that will, of course, push and increase demand elsewhere. China has very high crude stocks at the moment, is able to sit on them and draw down for a period. But we will get to a point where, on the crude side, security of supply means they need to begin sourcing elsewhere more importantly. And that is definitely the case for LPG, naphtha, and middle distillates around the world. The other thing, I think, the important thing to notice to mention as well is the Strait. We've got 16 to 18 million barrels a day of crude passes through the Strait of Hormuz every day prior to this. But there are pipelines that allow access elsewhere. And one of the key ones is the east to west pipeline through Saudi Arabia to the port of Yanbu in the Red Sea. And we're already seeing exports there, loadings there jump. They've got a capacity of about 7 million barrels a day. And we have seen fixtures there pick up. One thing I think we'll talk with Ellis again later is this does add a complication. The majority of these cargoes will be looking to go to Asia, but they're now arriving in the Red Sea and now need to pass through the Bab el-Mandeb Strait. And the Houthis have announced that this is a significant, that they are likely to attack vessels again, which is potentially adding some threat to vessels now moving in the opposite direction through the Bab el-Mandeb Strait. So that, at the moment we haven't seen any attacks from the Houthis, but again, that is now adding to the risk, and so freight rates out of the Red Sea are also very elevated there as well. Next slide, please. Yeah, so turning to the clean side, so it's not just the dirty side. Obviously, huge amount of middle distillates, naphtha, come out of the Mideast Gulf, and you can see here for Mideast Gulf Japan, naphtha has jumped very, very sharply. Mideast Gulf UK Cont in the other direction is also up very highly. But I've also here showing US Gulf UK Cont MRs. So rate has really jumped, and this is completely in a completely different geographical area. And the freight rates here have moved sharply. And this is because we are now beginning to see a lot of secondary impacts on clean and dirty tankers moving up. As I mentioned, US Gulf, China on the crude, and here US Gulf UK Cont. And this is because the UK Cont is obviously net short middle distillates, diesel and jet, and they need to begin sourcing those from other places. And the US Gulf is, on the diesel side, a major supplier there. Another one is, the other major markets you can see from the chart on the right is naphtha to Asia, LPG to Asia, and HSFO. And I'll come on to the impact for bunker prices shortly. These are the markets that we expect to see that they take a huge share of cargo via the Strait of Hormuz, and are most likely to see sort of big impacts. And as I said, the webinars tomorrow will cover this in a lot more detail on how those markets are evolving. But from a freight point of view, what it means is you're going to start to see changes. So freight on routes to those, alternative sources, freight for the on those routes is going to start to increase. So any other sources of naphtha, which includes Russian naphtha to Asia, middle distillates to Europe, LPG. We're already seeing force majeure announced across Asia at certain plants through lack of supply. On the bunker side, the main impact here is HSFO. Very large share of Singapore Asian HSFO comes from the Mideast Gulf, and specifically compared to the VLSFO. And that is very significant. I think it's around 35% of Singapore HSFO comes this way. So not only are we seeing cargoes having to be sourced elsewhere, bunker prices themselves are on the HSFO side are rising sharply across all bunker locations, and that is only going to be adding to sort of freight cost, and that's likely to remain the case as long as those cargoes are not able to exit the Mideast Gulf. On the LPG side, as we can see, LPG to Asia is a huge part. We're basically going to expect to see sort of a high premium for Asian markets to be able to draw US and Med barrels into the region. VLGC rates have jumped up to $111 a ton, which is, at least a 2 or 3 year high. Very, very significant jumps there. Houston to Asia VLGC rates will also find a lot of support because we're having to see that LPG drawn from the west to east. So again, very, very bullish across freight across all these markets. And then if we could turn to LNG. So on the LNG side, you can see the number of vessels is far fewer in terms of the impact here, and there's a lot more caution. The vessels are waiting much further off the Gulf of Oman, but here we've seen zero transits since the 28th, since the day of the attacks. We've got about 20 vessels trapped within the Middle East Gulf at the moment, which is about 2% of the fleet. Obviously, as you will be aware, Qatar Ras Laffan is offline following attack a couple of days ago. This is incredibly significant, and my colleagues will be covering this in the wider impact of this in the webinar tomorrow morning. But the Middle East Gulf accounts for around 20% of global seaborne LNG, and the knock-on effect of the loss of those barrels, those cargoes, is significant. Spark 30, which is the Atlantic Basin assessment, jumped $100,000 a day yesterday, which is the single largest increase. And actually, if we move to the next slide, we can see that impact here. So jumped very, very sharply. Obviously, we've had higher rates over previous periods, but most of the time they occur over historic winter months. I think the significant thing for the LNG market is, this is being driven by the fact that the JKM premium over TTF has really, really expanded. So this is, Middle East LNG, it predominantly serves the Asian market. So with Asia now particularly short, they're going to be sourcing from the Atlantic, the US, so they're going to be now competing more heavily with Europe. For the LNG carrier fleet, fundamentally, it's always imbalanced. When the spread favors Europe, when TTF, we tend to see the market oversupplied and low freight rates. But at the moment, as we're seeing now, we're moving to a period where the arb is favoring Asia, and then the market is fundamentally undersupplied. And that's what we're likely to continue seeing. As long as those cargoes remain inaccessible, we're going to continue to see very, very high freight rates on that market. And with that, I'm going to hand over to Alexis to look over the dry side.
Thank you, Matt. Good morning, everyone. So dry bulk shipping, obviously the headlines are being taken up by a lot about the tankers and the LNG trade, but still, this is an important part of an important market, and we do see an impact on the fleet. So there have still been some dry bulk carriers transiting the Strait of Hormuz, but transit's down 91%. And we've got about 280 bulkers trapped within that kind of Middle East Gulf region, which is about 1 to 2% of the global fleet. Now, those are predominantly going to be smaller bulk carriers, so things like Panamaxes, Supramaxes, handy sizes, because we don't see a huge amount of Cape-size trade through this region. Now, in terms of the impact on markets, now significantly, the Middle East Gulf region accounts for about 16 to 18% of global seaborne fertilizer exports. Predominantly, from Saudi Arabia, Qatar, UAE, and this will, these are not able to move at the moment, and also we're seeing disruption to the production because of the links to the gas plants and energy production. Now, the region is also on the import side a big importer of grains and oilseeds, predominantly actually corn, about 25 to 30 million tons per annum of grains and oilseeds by sea. And if we look across the kind of the other sectors, I mean, you will have seen, people watching this will see that, the aluminium prices have moved over the last few days because Middle East Gulf countries, they're producing about 8% of global primary aluminium production. We've already seen, shutdown at Kpler, which is a Norsk Hydro Qatar Aluminium JV. Looks like that's halted because there are no more gas supplies coming from Qatar Energy due to the shutdown there. Emirates Global Aluminium, they're taking in bauxite. We've seen cargoes there diverted away from the region. Their Al Tawila refinery, is located inside the region. So, in the short term, these places, they can, if they have energy supply, they can keep running from stocks, in terms of raw materials. But if we see an extended, interruption to trade, then we are likely going to, people are going to have to start looking at whether they can keep operating. At the same time, the Middle East actually produces about 3% of world crude steel production, but it is more important really as an import market for steel. So you've got steel coming in particularly from China, obviously the big steel exporter in the world at the moment. And we've had reports that producers in China have really stopped, offering cargoes to the region because the uncertainty at the moment means that they can't quantify the freight costs. So what that means for the rest of the world is, you're going to see for, steel prices there, people are going to be looking for new homes for that material, and there's going to be increased competition outside. Now, we haven't seen a massive impact on spot voyage rates, which I'll come to in a second. But overall, the effects of this, it is constraining vessel supply. You've got vessels tied up or taking longer to do voyages, and it's creating inefficiencies in the fleet. And this is going to overall, the net effect will be higher earnings. So if we just look at the benchmark dry bulk carrier earnings, really, really different to this chart on the left, really different to the tanker charts, because you're not seeing a big jump. These are the TC averages for Capes, Panamax, Supramax, Handies. And this is a bit of a function of the way these indexes are constructed. There is not a big Middle East component on these. So rates in the regions will be climbing, but we're not seeing it reflected in the market at the moment. And also, it's bear in mind that this region is not the big driver of the market. That would be, cargoes going into China. China is a big demand driver. Cargoes going into India. So in terms of shipping costs, we're not seeing a short-term spike. But as I said, over the medium term, if this continues, we will see higher rates due to those inefficiencies. Now, chart on the right here, we talked about fertilizers. So Middle East Gulf, 16 to 18% of global seaborne fertilizer trade, primarily sulfur and urea. You can see Saudi Arabia, close to 14 million tons. That's just from its eastern ports. Then you've got the UAE, Qatar, and a lot of that is linked to refineries. So, for example, your sulfur. And we've seen the shutdowns in Qatar and also in Kuwait. And, the sulfur, bear in mind, it's not just a fertilizer. This is for a base product that's used in other industrial processes, the manufacture of sulfuric acid that then goes on, into wider, chemicals and so on. So short-term implications, of this, people will have stocks. There won't be a major impact. If we look at, farming and fertilizers, Northern Hemisphere planting season, they're already going to have their supplies in. But if this continues for an extended time, we are going to start to see an impact. Now, The other thing I want to say is we talked about being a major importer of grains, so 25 to 30 million tons, and you can see that those volumes, this chart on the left here, monthly imports, regional grain oilseed imports, so Iran, East Coast, Saudi Arabia, UAE, Iraq, and then I've got another category there. There was more volumes going into Iran. That's primarily corn. Iran imported about 14 million tons of corn last year. A lot of that's from South America. That trade's going to grind to a halt. There were already challenges due to difficulties with payments. That's not going to continue. In the short term, countries in this region, grains and oilseeds are not going to be so much of an issue because they will have stocks. You can store corn, wheat in a silo and keep it there for several months. Where I think it's not reflected in this chart is the issue is going to be with fresh produce. Because domestic supply of fresh produce in the region is very small, and the majority of it is imported. Jebel Ali is the big import terminal for that. Also, where you get other perishables imported, livestock and so on. It's the biggest port in the region by some region. Your throughput about 15,500 TEU per year, about double the next largest port. That is the lifeline for about 50 million people in the region. There is not overland or air freight capacity to replace that. Obviously we've seen air freight is going to be difficult at the moment. So while I would highlight, regional grains, oilseed imports as an issue, I think fresh produce, particularly on the containers, that is where the real risk is to the region at the moment. Because, if we're not seeing, as you've seen, we've not seen container ships going through Strait of Hormuz. There's only so many supplies, only so long the existing supplies in the region will last. Now, I also then want to just talk about, the chart on the right here, which is we're looking at the Red Sea. I don't think we should discount this one as well, because we had seen something of a kind of not a normalization, but a gradual sort of movement towards normalization on this one. So the chart on the right, you can see percentage of seaborne dry bulks trade through the region, and there's a large drop off back end of 2023 as we saw those first attacks on shipping. However, in recent months, particularly fertilizers, again, fertilizers are very important for this region. That trade had kind of climbed back up again. We'd seen more grain. A lot of that is Russian wheat. We'd then been kind of, counting into our expectations that, we'd see a bit more of this, trade volumes would creep up, maybe, start to see a return. This obviously is not going to happen now. And we will see the volumes through there. We expect them to fall again. And what is the overall effect of that? It's going to be vessels diverting around the Cape of Good Hope, increased inefficiencies, and it will drive vessels earning. So to kind of summarize the dry bulk impact, really, if we're looking at individual commodity markets, we want to look at fertilizers, where there can be a global impact. The same with aluminium. For the region, imported grains and oilseeds are important, but also I think we should look there turning towards more the container fleet. Fresh foodstuffs is going to start to become an issue very quickly. And the overall effect, although we haven't seen a big spike in earnings right now, it will just be driving up earnings, because you're going to see more inefficiencies in how vessels are used, tighter vessel supply, and the market will go higher. Okay, I'm going to hand over now to Anna.
Thank you, Alexis. Yeah, if we're talking about the risk and compliance standpoint here, I think there are three main factors that are currently shaping the trade risk profile that we're seeing in the region. And the first one is obviously the signal jamming. Then we also have the physical attacks and the overall operational risks that Ellis had already touched upon a little bit. But with the commercial traffic largely suspended and around 3,000 vessels effectively trapped in the Gulf right now, the operating environment has been changed significantly. So let me start with what you're seeing here on the left, which is this map with GNSS disruption. So just to kind of say that GNSS is the umbrella term that we use for satellite positioning systems For example, a really famous system that's a GNSS system is called a GPS. I think that's one that everyone's heard of. And it tells exactly where a vessel is at the moment. Where, for example, IIS is a broadcast system. So we can think of it this way. For example, GNSS figures out your position on the map, and then IIS takes that position along with, your name, the speed, the course, and it transmits it so everyone else can see you. But this is where it gets interesting, right? Because GNSS is heavily integrated into military operations, especially for vessels that are running with advanced weapon systems. So when active operations are underway, that signals environments tend to change. So the militaries will usually jam signals during any kind of sensitive maneuvers that they are conducting, and you'll see the spoof signals are manipulating the position data that you see on the map here. You can't really see who is emitting the disruption because it just creates a lot of noise, but you can see the disruption happening itself. So you can kind of take a look at these strings that are getting stacked on the map. And what we've recorded since February 27 is pretty clearly a spike. In just the past 3 days, we've logged more than 10 confirmed GNSS interference incidents across both the Persian Gulf, but also the Gulf of Oman. And that shows that there is like a sustained, but also geographically dispersed electronic interference that's happening at the moment in the region. And of course, it's particularly concentrated around the Strait of Hormuz. But when signals are jammed, that means that the positioning kind of drops out, because when vessels are spoofed, they calculate false positions. And because IIS broadcasts are essentially also GNSS fed in terms of their coordinates, AIS data can then appear distorted as a clear consequence of this. And I'm saying this because there's a lot of noise that's happening in the market right now. I've seen, a lot of posts saying that vessels are behaving deceptively at the moment, and that is largely incorrect. What we're seeing primarily is a signal disruption when it comes to commercial vessels and coverage gaps. It's not really a coordinated deception when it comes to merchant vessels or those carrying cargo. Because we own the largest AIS data network, we're able to strip out a lot of that noise and distinguish real interference from when it's simply a case of data loss. So operationally, we can confirm that there's not a lot of maneuvering that's happening aggressively right now. A lot of these vessels are simply, stopped. They're effectively in limbo, and they pretty much have nothing to hide. In fact, it's quite the opposite. I saw recently a news outlet called the Hormuz a parking lot at the moment, and I actually couldn't agree more with that. And I think this matters enormously in Hormuz, as we mentioned. It's at its most narrow point, the strait is just 21 nautical miles wide. So roughly 20% of global oil and gas flows are moving through it, and some of that cargo is highly flammable. And when you're operating in a corridor that tight, even like short-term disruptions can increase a lot of like collision risk, grounding risk, and just overall negative exposure. So it raises friction, it raises uncertainty, and it also kind of complicates navigation overall. And again, as we mentioned, we have to see in the coming days if the U.S. decides to ensure that tankers transit with military escorts, which we know is something that Trump is considering as of yesterday, and we would expect to see more signal interference in that sense. But even more than that, we would likely see a pickup in high-risk activity. So that means ship-to-ship operations, spoofing of the shadow fleet or the sanctioned tankers that are effectively trapped there, to kind of intensify if we assume some kind of resumption of flows at that point. But what we're watching here basically is not like a random noise. It's a structured like signal manipulation, largely conducted again by military ops, one of the most critical, energy choke points in the world. So that's something to keep looking out for in the coming days. And then I think we can switch over to the next slide to also talk about some of the physical attacks that we've been seeing, because that is definitely another dimension to the risk profile that we're tracking right now. following, the declaration that the Strait of Hormuz is closed. So Iran's Revolutionary Guard has publicly broadcast warnings that no ship should be able to transit, and has carried out multiple strikes on commercial vessels in the area, which has been kind of the single largest contributing factor to the standstill that we're seeing in traffic and the dramatic increase in operational risk as well. So over the past 3 days, we've seen 6 confirmed attacks on different vessel types that were near or around the strait. And of course, that number could keep growing as we speak. But unlike, for example, the Houthi campaign that we also mentioned, the model that we've been seeing in the Red Sea, which showed that there was a selective targeting with some operational intent, right now we're not seeing a very clear pattern linking any of the affected vessels in terms of, like flag, ownership, operator, or even affiliation at times. So all merchant vessels, regardless of profile, remain pretty much exposed to threat at the moment. But to be actually completely specific, we did see a handful of vessels that are seemingly transiting. Those are going to be either the ones that are sailing under Iranian flags or just carrying Iranian cargo, usually destined for, China or India, suggesting that, some of the sanctioned or regime affiliated cargo is actually moving while others remain anchored or avoiding the corridor entirely. One other thing I want to mention is that at this time, there is no confirmed sea mine activity that's happening in the strait. We know that there's standoff drones, missile threats that remain active across the wider strait and the Gulf of Oman, which is creating like this persistent threat environment for the general traffic. But I think strategically, from Iran's point of view, a full blockade is extremely hard to enforce, given the size of the waterway, given the size of the naval forces of Iran, and the international nature of the traffic as well. So I think the main approach for Iran has been to make the transit, as we mentioned, commercially very unattractive. So higher insurance costs, operational unpredictability, elevated risk premiums, so on, everything to deter traffic without having to formally enforce shutting the strait beyond, measures that are realistic. And so I would also say when it comes to the US response there on the policy and sanctions front, we have to say that we do not expect like immediate new sanctions package while there are active military operations ongoing. So there's like a base case on an insight-wide level at Kpler of roughly 4 weeks or more at the moment, if I'm not mistaken, for this continuation of these operations. But new measures could then be rolled out actually in the weeks that are following the end of these operations, which is usually what happens. It's very similar to the patterns that we've been seeing with the Trump administration earlier in the year when it comes to Venezuela, right after the capture of Maduro. So, looking ahead, once we see cargo flows again coming into the more commercially viable angle, we then also expect to see, as I mentioned, a probable uptick in evasive behavior, dark ship to ship transfers again, because at that point, operators will need to prioritize economic incentives, ignore the traditional routing, and work on their own risk mitigation. So we're not just watching Hormuz, as I said. There's also potential spillover in the Red Sea because there's been clear signals of possible resumptions of attack in support of Iran. Again, no confirmed attacks as of now, but the rerouting pressure could reemerge as a compounding factor here. So I think just in the interest of time, to kind of sum up on the RNC side, the main takeaway would be that all of this combined variables translate into some tangible operational risk down the line, and it ties directly back into some of the freight cost dynamics that you also covered, Matt, and the insurance pricing that you covered, Alice, as well, and the overall global supply chain that we'll be talking about tomorrow on a separate webinar. So in other words, from the risk perspective, it's a wait and see situation, but the closure at this moment is more economical than anything else, I would say.
Brilliant. Thank you so much, Anna, for that. Right, we've got a bit of time now for the Q&A. So, and we've had a lot in, so we'll do our best to try and get through. I'm going to start, Alexis, with a dry one. You sort of touched on the food. There's a question that came in and said, is there basically a risk to food supply? And I was wondering, what I know you covered this a lot during the Ukraine-Russia. Like, what can we learn from the Black Sea grain export corridor? Like, are there any parallels there?
Yeah, so I don't want to be alarmist and start saying there's X number of weeks of food left in the region, but I mean there is a risk. At the moment, not because at the moment there is it's only been going on for a few days, so everything will be fine. But I think if we start to get into a period of weeks, then we maybe have to start looking at that as a risk. I think we look for kind of in these situations as analysts, we look for kind of what can we learn from the past, what's happened in previous examples. The Ukraine, Black Sea grain exports is, obviously that's trade going, wheat and corn as opposed to and barley as opposed to oil. But we can learn something from that. So when we saw the initial attacks on the sort of full-scale invasion on Ukrainian ports, we saw vessels stuck in the ports. People, very similar to this situation here, where vessels do not want to go through, a dangerous waterway. We saw, changes in the insurance market, which I'll let Ellis talk about that one. But fundamentally, what we saw as the market kind of adapted, we then saw an export corridor. So we kind of saw an exodus of vessels that were trapped in the region. So we had crazy situations where there were kind of like passenger ferries having a few bags of grain load on board so that they could then move out of the region. And then we saw a kind of a setup where we had, inspections, escorted vessels, and a kind of a movement, to restart exports. That worked, but fundamentally what it does is it's very inefficient. This is not an efficient way to run a trade operation. What do inefficiencies mean? Costs go up. So it takes longer because vessels often have to go to a waiting area. They have to wait for safe transit. Maybe in this situation, we need an escort. That all adds to time. And we also saw, particularly in the Ukraine example, a switch to using older and smaller vessels. Now, my view on this, Ellis may comment, is that it's bringing down the insurance costs because your vessel is not worth as much. It's not carrying as much cargo. But then if you're trying to move volumes out of a country or into a country, that means that it's less efficient. So again, costs go up. And we also saw a prioritization of certain commodities. So for example, corn exports, barley exports, fine. But issues with, for example, fertilizer trade, some trades, fertilizer imports into Ukraine are halted because of the explosive risk. And the really big risk, from a logistics, from a maritime perspective, is in this kind of war environment is you get a vessel that gets, for example, sunk on a berth. You then can't move it. That berth is then effectively closed until you clear the vessel, or it gets caught in another choke point. We've just been talking about how narrow the Strait of Hormuz is. If we ended up with one or more vessels, either stranded, unable to move, or sunk, that's the that can then create more choke points. And just before I kind of hand over to Ellis on this one, the other thing is the longer this goes on, the harder it is to rectify. So what we saw in the Black Sea was that vessels parked up and then the crews left because quite rightly, they didn't want to be in a war zone. If you then want to start those vessels, you've then got to bring another crew in. You've got to do some engineering work to get the engines up and running again. Maybe you've got a cargo on board that's been sat there for days, weeks, Again, it's adding to costs, it's inefficiency, and there is no easy way out of this. There is still not a return to kind of normal trade there.
Yeah. No, that's very helpful. Ellis, one for you. It said, you sort of touched on this, but I think just to clarify, one of the questions is, it said that insurers just have not got sufficient intel to issue war risk. How would you respond to that?
Not sufficient intel. I'll quickly just touch on Alexis's last question of
Yeah, go for it.
the smaller vessels and older vessels do bring the cost down, but insurance is rated on a percentage basis. So if you're shipping less goods, then you pay less premium. But it's all relative. It's all a sliding scale. It's probably more of an aggregation risk rather than not wanting to lose a big cargo and a big ship rather than wanting to lose a small cargo and a small ship. In theory, if you buy insurance on a bigger vessel and a bigger cargo, your economies of scale are better and your relative price is cheaper. Obviously, the dollar figure is still higher, but we scale in that way. Um, so on in terms of information, as an industry, insurance has always been very closely linked to information providing services such as Lloyd's and Lloyd's List are a very long, old-standing relationship on the maritime intelligence world. These days, we use a range of tools, Kpler being one of them, of course, and we have contacts within the security industry, within the analytical side for both shipping and trade. We have analysts on governmental issues. I mean, as an industry, we probably hire as many analysts as any other financial sector. If you, especially you think on the size of some of the insurers that are taking this risk, and those insurers are enormously well capitalized, some and in some sense more so than banks, and the liquidity requirement around running a big insurer, it means you have to have more cash available than a bank does because you need to have the ability to pay out claims. I think the assumption that we don't have the intel, I don't think people would be taking on the risk if they weren't comfortable with the intel.
Yeah.
And then, I mean, but there's obviously an element of the unknown. Look, we write risk. There is, of course, we don't know. If we knew for it that something was going to get hit, then why would we cover it in the first place? It's a bit of a law of large numbers when it gets to a size of a portfolio. If you can hedge by if you write enough of this business, then you can afford to pay out the claims when something does go wrong. It's the same way that, on a really simple sense, how car insurance companies work. If they insure 1 million cars, then they're not bothered about a few hundred getting written off every year. Everyone's happy to pay a small amount in, so then in the event that the worst happens, you're not paying out for your entire vehicle, which you probably don't have that cash sitting around.
Yeah.
But
Yeah.
in terms of intel, no, we spend a lot of time, effort, and money on intelligence.
Brilliant. Thank you. Anna, you actually touched on this saying there's no sea mines at the moment, but one of the questions is what is the procedure for laying them out? Is it easy to implement? And then what about removing them again?
Mm. So they are deployed by a number of different methods. So it could be a ship, it could be a submarine, it could be an aircraft. They pre-place them like they're pre-armed or programmable mines that are in specific maritime zones, and then they remain anchored there, or they drift and detonate when they're triggered. And so they can be triggered by contact. So that could be like also magnetic. I think it can also be acoustic. It can also be like a pressure signatures. There's very different types of this. And then in terms of is it easy to lay them and remove them? Laying mines, I think, is relatively simple. It's quite inexpensive as well compared to most of the naval weapons that we see these days, which is why many states and even non-state actors can implement mine warfare with some limited resources. But then removing them is another story because that's quite a slow process and it's more technically demanding and it's more risky as well. So that typically will require some specialized countermeasure vessels, divers sometimes, or if it's a bit more sophisticated, then it's a remotely operated vehicle that will detect it and then basically neutralize it. But it needs to be each mine individually. So yeah, I think that kind of
Can I jump in on the mines question as
yeah.
well? It's a slight segue. Mines are a really difficult issue for us as an industry, but it's limpet mines that have been particularly challenging for us in the one, and that's not really in this theatre of battle yet. It's been more, and hopefully not at all. It's been more in the Black Sea. We've seen Ukraine and Russia using limpet mines, which are the divers will go down onto a vessel while it's in port and attach. I mean, it's a limpet, like it's like a barnacle that attaches to the side of the vessel, and then the vessel might effectively have its fate sealed, and then not actually know about it for weeks later. And we've seen limpet mines go off in the Mediterranean. We've seen I think a port in Italy, a limpet mine went off that believed was attached while still in Russian waters, and that for us on the risk modelling side, we anticipate not that not any have been laid yet, but if mines are laid in the Strait of Hormuz, it's not like people are going to be overly surprised. when a mine goes off on the side of a ship in in a port in Italy, then that's pretty shocking. I think the evolution of mines is quite a scary concept.
Yeah. We are very much at time there. Unfortunately, we've had a huge number of questions come in. Unfortunately, we won't be able to get back to, we'll aim to maybe to reply to some of them after the session. Unfortunately, there's of course going to be, there's a huge amount of interest, huge amount of uncertainty, around how long this is going to last, the potential for further spillover. And I think I can say for everybody that nobody has an answer to those questions at the moment. But thank you so much for joining us today. Like I said, we have another webinar, two webinars tomorrow morning, which I really recommend, which will be covering more on the oil and the gas side, and they'll go into a lot more detail on how we see those markets developing and how the market is going to adapt. So please, thanks very much again for joining us, and thanks to Anna, Alexis, and Ellis for joining me, and we'll see you again soon. Take care.